All right, let's talk about ADTRAN's second quarter for 2025. On the surface, it really looked like their big recovery plan was finally starting to pick up some serious steam. But the way the market reacted, whoa, that told a completely different story. And this is the whole puzzle right here, boiled down to its simplest parts. On one hand, you've got a revenue beat. That's fantastic. It's exactly what you want to see from a company that's trying to turn things around. But on the other hand, you've got the bottom line, the earnings per share, and that was a miss. So right away, you've got this tension, this conflict that investors are looking at and trying to figure out. So how did investors resolve that tension? Well, the verdict was pretty swift and pretty brutal. The stock got hammered, down a whopping 11.5% in a single day. I mean, this wasn't some little wrist slap that investors just shrugged off. No way. This was a huge red flag that something in the company's story just wasn't adding up. So that's the million-dollar question we're going to dig into here. How can a company have growing sales but still get so completely punished by Wall Street? What really went wrong? Let's break it all down. Okay, first things first, let's get inside the numbers. Because, the headlines only ever tell you half the story. We're going to look at the good, the bad, and the break-even point, which turned out to be the most important number of all. So here's the scorecard for the quarter. Revenue came in strong at $265.1 million. That's a solid beat, about $4.5 million better than expected. But then you look at the non-GAAP EPS. And just so we're on the same page, that's the earnings number with some of the one-off accounting stuff stripped out. It came in at 0, a big fat 0, break even. The analysts were hoping for at least 2 cents a share, so that's a clear miss. The real story here wasn't the sales, it was the complete lack of profit. And this right here really paints the picture of why investors got so nervous. It's all about the trend. See, last quarter, in Q1, ADTRAN actually made a little money, 3 cents a share on that non-GAAP basis. Everyone saw that and thought, okay, awesome, the recovery is real, they're profitable again. But then this quarter, boom, all that progress just vanished. It stalled out completely, right back to 0. That reversal, that feeling of hitting a wall, is what really spooked everybody. But hey, it wasn't all bad news, and we gotta give credit where it's due. This number was a huge bright spot. They generated over $18 million in free cash flow. Now, this is super important. It means that even though the accounting profit was 0, the actual business operations are spitting out real cash. That cash strengthens their finances, gives them more breathing room. It's a very healthy sign, even if it's not showing up on the bottom line just yet. Okay, so you've got this really mixed bag of results. Good sales, bad profits, good cash flow. So what was management's take? How did they try to spin it? Well, as you're about to see, they went all in on the growth story. And here it is, straight from the CEO, Tom Stanton. He came out and hammered the positives. The message was crystal clear. Hey, look at our sales growth. Look at all the cash we're making. He was really trying to frame this as a story of solid execution and building a stronger company for the future. And they didn't just stop with the high-level message. They really tried to back it up. They talked about grabbing more market share, about how their technology is perfectly set up for massive trends like AI and the cloud, and, this is a big one, that their biggest customers are finally starting to open up their wallets again. The hidden message in all of this was pretty clear. Hey investors, don't worry about the lack of profit today, focus on our amazing position for tomorrow. And to show they were confident, they put out their guidance for the next quarter. They're expecting sales to keep climbing, somewhere between 270 and 280 million. But, and this is the really critical part, look at that operating margin guidance, 3 to 7%. I mean, wow, you could drive a truck through a range that wide. And that tells you everything you need to know about just how uncertain even they are about turning those sales into actual profits. All right, so we've got the hard numbers and we've got the story management is telling. Let's put it all together and figure out the final verdict. Why did the market just absolutely reject this story? It all boils down to this. ADTRAN has officially become what we call a show me story. Think of it like this. For a while, investors were patient. They were saying, okay, we see the sales are coming back, we'll give you the benefit of the doubt. But that grace period, it's over. The market is now saying, we're done listening to your stories about growth. Show us the money, show us the profit. And if you want the specifics, here are the real killers from the report. First, that break-even number was just a flat-out failure. Second, that 3% operating margin for the quarter was razor thin. But honestly, the biggest concern for serious investors was the total lack of what we call operating leverage. I mean, think about it. Your sales are up a whopping 17% from last year, but your profits are flat? That's not good. That screams that something is wrong. Maybe you can't charge enough for your products, or the stuff you are selling just isn't very profitable. So, all of that brings us to our final take, what we call the next call. Where does the stock go from here? And more importantly, is there a way to trade it? We're slapping a market perform rating on this stock. And what that really means is we think it's probably going to just tread water for a while, performing in line with the rest of the market. You've got this classic tug-of-war going on. On one side, you have the very real potential of that revenue growth, but on the other side, you've got this huge, heavy anchor of margin pressure that's just dragging the bottom line down. For now, it's a stalemate. So if you were feeling aggressive, how might you trade that stalemate? Well, here's one idea. The basic thesis is this. The stock is going nowhere until management proves they can actually make more money. So the trade itself? You could look at a bearish option strategy, like buying puts. That's basically a bet the stock will go down. You do this right before the next earnings report, positioning yourself for another profit miss. The big catalyst, of course, is that Q3 report. All eyes will be glued to that operating margin number to see if they can hit that 3 to 7% target. Now, what's the risk? It's simple. Management actually does it. They execute perfectly, hit their numbers, and the stock absolutely soars, which would mean your trade gets wiped out. And we have to end with our usual, very important disclaimer. This analysis is for informational purposes only. It is not financial advice.